bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the June 9th, 2026 episode. This week's episode concludes a conversation about tax credit equity that started with part one last Tuesday, with all the same guests that you'll see today. Today in this episode, we're going to cover the demand side of tax credit equity investment. For the supply side, please check out part one of this episode, which dropped on June 2nd. Now, my guests in this and that episode are Brad Elphick, a partner in Novogradac's Metro Atlanta office, and he's here to discuss all things new markets tax credits. Tony Grappone is a partner in our Andover, Massachusetts office, here to discuss renewable energy tax credits. Mike Kressig is a partner in our St. Louis office, here to talk about historic tax credits. And Dirk Wallace, a partner in our Dover, Ohio office, here to also talk about long-term housing tax credits again. Now, anyone who did listen to part one knows that in part one, I had said we were going to talk about the typical investors in these various tax credits, but in the interest of time, I skipped over that, and it does fit in quite nicely with this part two, because in this part two, we're going to cover factors that influence equity pricing as well as who chooses to invest in the given tax credit. So the factors that influence equity pricing and who the investors are. We're also going to talk about possible legislative or regulatory approaches that could increase tax credit equity demand, tax credit investor equity demand. And as I said in the last episode, increasing tax credit equity demand is a win-win-win. It's a win for the individual projects becoming financially feasible. It's a win for those who are going to benefit from those incentives, as well as the federal government, the taxpayer, because you're getting more bang out of the same amount of tax credit dollar cost. So I think it is something that we should always be working for under any circumstances. We have a lot of ground to cover. So if you're ready, let's get started. Now, for a full introduction of my guest, you can go back and revisit the first episode. Of course, the link to that episode will be in today's show notes. And I wanted to start here by level setting as to some of the many factors that affect who the investors are and how much they're willing to pay for a given credit. And I've bracketed these into four categories. One is market conditions. The second has to do with bank-centric matters. The third is the tax attributes of a tax credit. And then the fourth is a catch-all other category. Now, I'm going to go through this relatively quickly. And if you're not that familiar with these issues or these factors, I certainly won't be able to take the time to explain them in a lot of detail. But in doing this, I did wonder if we should have a separate podcast where we actually go into these in a lot more education detail. I decided that rather than just decide, yes, let's do one, I'll leave it to the audience. So if you think we should record a separate podcast where I go into these factors in a lot more detail, please just post a comment on whatever podcast service you use that says you'd like us to do a more detailed analysis of factors affecting equity pricing. You can also send an email to us on the contact@novoco.com email address. And if I get a sufficient number, we'll do it. And if I don't, then I'll know it's not in demand and I won't. So now let's talk about the four major categories. As I said, market conditions, bank-centric matters, tax attributes of the credits, and other. And this is not exhaustive list, but it is a relatively long list. So in terms of market conditions, there's probably three major areas that I think about in terms of market conditions. One is the actual supply, how many newly minted credits there are every year, which we did talk about and estimates of that in the first episode. Second, I think about interest rates and inflation, which affect what competing yields are for investors. When they're looking at investing in community development tax credits, renewable energy, affordable housing, and the like, they are comparing it to other investment options. If interest rates are higher, inflation's higher, then as a consequence, yields have to be higher. If yields are higher, all things being equal, tax credit, equity pricing lower. So supply of credits, interest rates, inflation. And then third is the state of the economy. At the end of the day, these are tax incentives. If the economy is not in very good condition and companies aren't making a lot of profits, they don't need a lot of tax credits and tax losses. The impact of the economy, and more particularly the impact of the economy on the particular investors in these incentives, is very meaningful. Those are a handful of the items in the market conditions category. Turning to bank-centric areas, and number one, Community Reinvestment Act. Community Reinvestment Act creates incentives for banks to invest in many of the incentives that we're talking about here today. There's also capital risk weighting. If a bank does invest in these sorts of investments, they have to set aside a certain amount of capital, and how that's weighted, how much capital they set aside, has an impact. And third, banks have a limit under the public welfare investment test or requirement that limits how much they can do up to a certain level. And if banks are getting close to their public welfare investment limit, they may be limited in the amount they can invest. So when I think of bank-centric, CRA needs, capital risk weighting, public welfare limit. Then is tax attributes of the credits. And there's a number of factors here that are both, I should say, tax attributes of the credit, as well as other factors that affect how an investor in the credit can claim the credit itself on their tax return. And here, I would say you can look at the overall limit under general business credits. There's a 75% limitation on offsetting your tax liability. If an investor gets close to that limit, then they can't invest. They won't get any benefit from investing more credits for a while. So that's a huge effect. Whether or not an investor can use the credit to offset AMT can have an impact. Renewable energy credits are transferable, and that creates an impact on the value of the credit. Carryback periods can affect renewable energy. Has a 3-year carryback. The general rule is 1 year. That make it slightly more attractive for renewables, particularly in combined with transferability. We mentioned in the last episode the taxability. The new market tax credit, the historic tax credit are 100% taxable. LIHTC isn't taxable at all. The investment tax credit for renewable energy is 50% taxable. We did talk about that shorthand. The credit's not taxable. It's just there's a basis reduction and recapture losses at the end. The credit term has an impact on the value. If you're claiming the credit when you place in service, you're claiming it over 5 years, claiming it over 7, claiming it over 10 years. And then, of course, the recapture rules, they play in. What's the risk of recapture? What's the experience with recapture? And to what extent can you get tax credit insurance to help deal with recapture issues? So those are some of the tax attributes of the credits, and just generally the way the code operates with respect to various credits that can impact value. And then my catch-all other category, which is my number 4 category, has to do with ESG, impact investing, other public commitments. Are they rising or falling? Are public corporations more or less interested in doing these than private individuals? GAAP accounting. If you're a publicly traded company, you care about how it affects your books and records. There's the potential for a global minimum tax that could have an adverse effect on equity pricing. And I'll also just note that the Federal Housing Finance Agency sets limits for the amount that Fannie and Freddie can invest in low-income housing, which I'm sure Dirk will mention. So they play a critical role in determining how much those two government-sponsored enterprises will invest in locally tax credits. So anyways, I just want to throw all those out there, and my guest will then talk about which ones of those have the greatest impact in terms of shaping the investor market in the areas where they work. And if you would like a podcast with a deeper dive, where I'm not talking so fast, happy to do that. If you think it would be of interest, just send an email to contact@novoco.com or post a comment on the podcast that you're watching or listening that you would like to see that episode. Okay. So that was a lengthy introduction. Thank you for your patience. Let me start with you, Dirk. If you could share with our audience who the typical investors are in the long deposit tax credit, and which of the issues that I talked about do you think are most pertinent in the near term to equity pricing effects?
Sure, I can do that. Primarily in the low deposit tax credit space, we have a lot of banks and insurance companies that are primary investors. Mike, as you mentioned, we also have Fannie Mae and Freddie Mac. It used to be they were authorized for $1 billion of investment each. Last year, about mid-year, that authorization went from 1 billion to 2 billion. Because it was that increase, we didn't see the full 2 billion being spent. With Freddie Mac, they published their report, and Freddie Mac said they were able to invest about 1.2 billion of their 2 billion. There's still more investment there for both Fannie Mae and Freddie Mac. But the main thing that I think a lot of the LIHTC industry focuses on are the banking and regulatory features that you had mentioned, because banks have a big investment in loan causing tax credits. The one thing that you had mentioned, the public welfare investment limit, right now it is at 15%. And we're hearing banks getting close to that. A few banks maybe were really close to that and maybe started to divest some of their investments. So that definitely is an issue that's on everyone's mind. Can that be increased? And there is legislation out there that's pending to increase that limit from 15 to 20%. It seems like that would have a notable impact because it's based on the bank's risk adjusted capital that they can invest. And 5% of that is likely a very, very large number. So that should definitely increase their demand for tax credits. CRA, Community Reinvestment Act, that plays a big role in demand and in pricing in general, because if there's a lot of demand in certain CRA markets, it typically would command higher pricing. So when we talk the upper ranges that we talked about on the last podcast, those upper ranges typically would be your high CRA markets where there's a lot of demand for loan causing tax credits.
Right. Thank you for that. I will also just layer in, because if I don't, I'll hear about it. In addition to your CRA needs, the public welfare investment limit, as well as the capital risk weighting, how much capital you have to hold against the investment. I do also know that there are a number of large bank investors that are running up against the 75% tax limitation. And when I think of the loan for the tax credit space in particular, and steps to take to increase sort of bank investment, I think of the capital risk weighting, I think of public welfare investment limit, I think of the 75% limitation. And depending on which bank you are, one of those levers is the one that is restricting you. And if you do soften that, then one of the other two might kick in. So it's one of those all of the above strategies in terms of trying to help increase bank investor demand. Is there anything else you wanted to say about the investor market for loan causing tax credits?
I think the loan causing tax credit market really doesn't get into the individual market. I know there's been some exploring of that, but there's passive activity rules and a whole host of reasons on why individuals are limited where they may invest in other credits. But I think the big focus is really on the banking and any regulatory changes we can.
I will just note, to expand the individual discussion, that individuals were the key investors right at the start of the credit, but that was because yields were higher. It was very costly to raise the capital once banks came in a big way in 93. And just really, actually, it was corporations first and then banks. Why they held corporations? Because they didn't have the passive activity rule limitations. Then the market just drifted completely away from individuals. And when we think about all the credits we're talking about here today, the passive activity rules really limit individual investment in loan causing tax credits and historic tax credits because they're rental activities and they're per se passive. Also limits renewable energy because you have to materially participate in the activity. So renewable energy generally is difficult for individuals to invest. I will note that with new markets, the credit itself is not a passive credit. So you would think individuals could invest in new markets at scale, but the new market tax credit does not offset the alternative minimum tax. So as a consequence, you can't get individuals investing in new markets as well. So across all four credits, we're not going to see individuals playing a key role, unless one of you can share with me an example where that wasn't the case. And there are unique situations where that's not the case, but it's certainly not programmatic. It's more episodic.
And I would add that when looking at loan causing tax credit, as you mentioned, it's coming up on this 40th anniversary. And a lot of the things that you've mentioned that might be problems for other credits, loan causing tax credit, we've already worked through that. So we have the correct GAAP accounting treatment with proportional amortization. We offset AMT. I say we, meaning, but yeah, a lot of things I think my colleagues are going to mention. The loan causing tax credit, just given the amount of time it's been around, was able to navigate through those issues or get changes for the credit.
So Brad, please talk about the typical investor in new markets, which isn't going to be too different than LIHTC.
Yeah, and I was about to jump in to try to go next anyway, because I think it made sense that many of the same bank investors in the LIHTC space are also new market tax credit investors. New market tax credits is primarily, almost exclusively, financial institutions, it seems like. And with it being a smaller market they can absorb almost all of the tax credits. And so there's not much of a secondary market to sell it to corporations, insurance companies, or others. The banks really have enough appetite for the new market tax credit. And so as we've talked about here, and as we talked about on the previous episode, the problem, or not the problem, the difference is how different these tax credits are, right? And so the banks will each have a different strategy of which tax credits they will ultimately prefer to fill their tax credit appetite with, right? Because new market tax credits is a 7-year credit. It's taxable, as we've talked about. It has other features to it that may not be as desirable as one of the other tax credits. And so ultimately, banks are looking at a tax investment strategy holistically, and then determining how they're going to divvy up that between the different tax credits. And so from a new market tax credit space, I'm always trying to figure out how can we make new markets look better than the other tax credits, right? And that is a big factor in that in terms of a pricing perspective. I think that we would see a greater increase in pricing if you could put it more on par with the low-income housing tax credit, just by changing it from a taxable credit so that there's no basis adjustment, as we talked about. So I think in addition to all of the bank factors that Dirk talked about, those are all applicable for new market tax credit investors as well. And then I think just two, it's really the competition between the other credits that seems to impact new market tax credit investors.
Thank you for that, Brad. Thank you for the comparison across the credits. And I will share in the show notes my written testimony from the Senate Finance Committee a couple of years ago. There are a number of good charts in there that compare the various credits in terms of their term and the basis adjustment and the like. I'll put those in the show notes so the audience can turn to those and get a little bit more detail, more granularity across the various credits. So let me save renewable energy to bring up I'll go to historic tax credits next. Mike?
Yeah, the investor pool for historic tax credits is a little bit different than it is for LIHTC and new markets. We still have banks as a reasonably large share of the market, but that's really even reduced a lot in the last 10 years, with a number of the bigger banks leaving the HTC market for the renewable energy space or other credits when the historic credit went from a 1-year credit to a 5-year credit with the Tax Cuts and Jobs Act. Now, there's no published data that I'm aware of that says how the market's broken up, but I do talk to my syndicator friends often and am aware of the fact that there are still a couple of big banks that take up a certain segment of the market. If I had to guess, I would say it's roughly 40% banks, 40% insurance companies, and 20% widely held C Corps. And again, the bank percentage is down pretty markedly over the last 10 years or so. As I alluded to a minute ago, the biggest factor affecting HTC pricing is tax credit attribute, which is the fact that it's a 5-year credit. And certainly when it went from a 1-year credit to a 5-year credit, pricing dropped, particularly once the grandfathering properties were placed in service. And so that, in addition to the decrease in net present value that's obvious, again, my syndicator friends would tell me that it's just less desirable in a lot of cases because investors, a certain segment of investors, don't want to commit that far out. And so that has a difficult to quantify impact, but it has an impact as well. So a return to the 1-year credit is the top legislative priority of the HTC lobby. We were pretty optimistic there for a few minutes in the lead up to the One Big Beautiful Bill, but unfortunately it didn't end up in the bill. But it continues to be the top legislative priority. Other factors, if we're looking at attributes, certainly taxability is one. That was probably our number 2 priority in the Historic Tax Credit Growth and Opportunity Act. Interest rates are obviously a factor. The bank-centric factors are not big in HTC. If CRA is not an automatic thing, some projects qualify for CRA, but if they do, it's a bonus. The syndicators don't typically syndicate CRA funds per se. The last thing I would mention as a factor is that with the increase in state credit programs, many of which allow the credit to be offset against premium tax, there's a very strong demand among insurance companies for the state tax credits in those states. And that can result in them paying a premium for the federal credits.
That's a very good point about the state credits, and I'll link to it. But then many months ago, I did write a Washington Wire where I did an analysis of the usage of historic tax credits across various states. And Tennessee does not have a state historic tax credit. All the states around it do. And they have multiples of the amount of historic tax credit investment that Tennessee has based upon the attractiveness of the state credit combined with the federal. And I would say that that's part, in my view, that because the federal historic credit has its value has reduced over the last 10 plus years due to the Tax Cut Jobs Act taking it from 1 year to 5, due to the guidance about the taxability treatment of the credit, along with some court cases that question certain structures. Because of those various factors and others, it's sort of declined. So it's not as powerful on a standalone basis, which makes the state credit really important, because doing historic credit renovation does have higher costs. And the historic credit, as it is now at the federal level, it doesn't necessarily cover those added costs. So you need to have some additional support to make the project financially feasible. But with that, let's turn it to Tony. And you can talk about both the 1 year credit, the beauty of the 1 year credit on investment, but you also have the 10-year on the production.
Great. Okay. Thanks, Mike. All right. So in renewable energy, as far as the types of investors are concerned, you have all your options out there. You've got your banks, you've got your widely held C Corps, insurance companies. You can see individuals, but for all the reasons you noted, they make up a very small share of the overall investor market. As far as banks are concerned, Dirk and Brad kind of pointed out some of the bank-centric issues that come into play with bank investors. I'd say those all come into play with renewables as well. You got the 75% limitation. You got the capital risk weighting issue. On the bank side, if you've got a smaller bank, if renewable energy investments got automatic qualification for CRA, maybe you drag a few smaller banks in, or maybe you see larger banks invest at a bigger level. But generally speaking, renewable energy investments, they don't automatically qualify for PWA or CRA credit. They can qualify, but they don't automatically qualify. You might see more investing from banks there if they did. I think that's a nice perk that new market tax credit investments and LIHTC investments benefit from that renewables just don't. But those other factors come into play. Other issues that really impact as far as market conditions are concerned, interest rates are a big factor. Also the federal corporate tax rate. If you go back, 2017 at this point, when the federal corporate tax rate was still 35%, the average tax credit pricing for renewable energy partnership investments was probably 10 to 15 cents. You get 10 to 15 cents more. So earlier I talked about partnership flip investment pricing at that $2 to $1.12 range. Well, if it was a 35% tax rate, you'd add probably 10 to 15 cents to that pricing for a couple of reasons. One, the federal tax rate plays a huge role in how much the depreciation benefits are worth, right? And so at a 35% tax rate, depreciation benefits take on more value. Well, if there's a 35% tax rate, you just have more tax liability as well. So you just have more just inherent demand for tax credits. You take that tax rate, you bring it down to 21%, and obviously that's going to lower the demand you just need fewer credits and the losses are worth less. And so as a result, the pricing comes down. Interest rates, similar story. If you go back to, say, 2017 and beyond, the interest rate environment was historically low. And so that also helped prop the pricing up. We've seen interest rates creep up for a while now. And so obviously interest rates go up, investors need more yield. So as a consequence, their pricing comes down. General market conditions, like you said, if the economy is doing particularly well, companies are more profitable, they need more credits, et cetera. And then as far as other issues that come into play, you mentioned gap issues, financial reporting issues, basically. In the low-income housing credit program, investors have the proportional amortization method. That's a very simple, easy to understand, easy to apply accounting method for investors, provides really nice, predictable, a nice earnings profile. Most of the earnings attributes fall below the line. Investors tend to really like that. Although renewable energy investors can consider proportional amortization like you use in affordable housing, they don't automatically qualify for proportional amortization. If they don't meet the proportional amortization criteria and they're an equity method investor, then they have to use what's called the hypothetical liquidation of book value accounting method to account for their investment. And compared to the proportional amortization method, HLBV tends to be a complex area of accounting. It's subject to a lot of interpretation. You get varied interpretations in the marketplace. And as a result, you get a variety of applications as well. On top of that, the sort of earnings profile, it's not as predictable as it is under the proportional amortization method. You also get a significant portion of the earnings that can actually flow above the line, and investors are obviously very sensitive to above the line earnings results. So anyway, in renewable energy, the GAAP accounting treatment is actually a fairly important consideration when an investor is trying to get into the market. Now, when do you see these types of investors? Like, when do you see a bank investor versus a widely held corp? That kind of comes down to the size of the credits, right? And so if you're looking at a portfolio and the credits are 25 to 50 million or 25 to 75 million, you're going to see a lot of banks in that area. You might even see some insurance companies. You can see insurance companies in that $10 million to $50 million range. Banks come in more like that $25 million to $50 to $75 million range. You could see widely held corps as well in that 25 and up, over 100 million. Now you're starting to see credits that are being transferred. Now you're not talking about partnership structures as much. You're either talking about straight up transfers, or maybe you're talking about a syndicated fund that comes in where you've got a fund sponsor that's creating an upper tier partnership that's bringing in some large corporate or a group of corporates that are coming in to monetize a large amount of credits. And so the size of the credits can also play a significant role in terms of who the actual investor is and what they're paying or how much they're investing. The demand for credits, PTCs tend to trade for a little bit higher in the marketplace than ITCs. And the reason for that is because the ITC has a recapture period associated with it, which is 5 years. PTCs don't have that same kind of recapture risk, even though recapture is fairly unheard of across all these credit programs. Investors are still sensitive to it. And so the fact that the PTCs just don't have that recapture risk helps prop up the value of those credits a bit more. Another nice thing about PTCs that I think elevates the pricing, you can have an active, or you do have a secondary market with the PTC program. And so you can put a partnership together where you have the initial investor that comes in and is monetizing the PTCs. But during the credit period, that investor can go out and monetize the rest of that 10-year credit stream with a different secondary market investor, which you just can't do with the ITC because, first of all, the ITC is all claimed up front in year one. And then two, you've got a recapture period that prohibits significant ownership changes during that recapture period. So that added flexibility and lower recapture risk with the PTCs helps prop up that value a bit.
Tony, if I can jump in real quick, Mike, I'm glad you brought up proportional amortization because we obviously spent a lot of time on that, not only when it was initially implemented for low-income housing tax credits, but then in version 2.0 when it was broadened to include all tax credits. While Dirk was right, it would be nice if all of us could be like LIHTC and have everything figured out. LIHTC gets to use proportional amortization very, very easily. It's becoming a much bigger issue for new market tax credits for investors. Unfortunately, the result of the changes, while it does allow for new market tax credit investors to use proportional amortization, there are some issues with being able to qualify to use it. And so it hasn't been the silver bullet that we had hoped for. Many of those investors are struggling with that issue. And also, as the amount of allocation has increased and the potential for a secondary market has increased as well, proportional amortization is an important factor to those secondary market investors. And so trying to sell them on new market tax credits versus another tax credit like low-income housing tax credit or ITCs, it's something that they're having to consider. And all of these are friction points for investors. If we can remove any of these friction points, it just allows more of the benefit to reach the intended beneficiary. At any point in time, one could be more escalated than the other. And if you asked me this question 5 years ago, I'd give you a different answer as to what are the most important ones. And I'm sure 5 years from now, I'll give you another answer as well, because all of these things change. Nothing operates in a vacuum. Everyone's like, what will increase pricing? Well, how long do you have to answer that question? How many levers do I have to pull? And that's what we're ultimately talking about. We can reduce friction points along the way and realize, to your point, that there has been low recapture. So reducing some of these friction points like risk weighting or PWI or the 75% limit, like for these types of investments, there's a long track record of their success, and what those limits were put in place for may not necessarily be the smartest way to limit investors in these programs.
Thank you for that, Tony. Thank you for that, Brad. That was a good segue into our next topic. And it'll be our concluding topic of our roundtable discussion. And that has to do with the potential for legislative or regulatory change that could have a positive, I guess, also a negative impact on tax equity. But what I'd like to do is just list a handful of items that I'm aware of. Once again, not an exhaustive list, and our audience should email contact@novogradac.com and or post on the comments section of the podcast other items that you think are equally or more pressing or even less pressing, but you want to make sure that we're thinking about them. And there are a lot of items we're thinking about that aren't on this list. But when I think about looking across the various community development tax credits and what are some of the potential changes that could have a positive impact, I think of, and once again, in no particular order, we've talked about the public welfare investment percentage going from 15% to 20%. It is in the bill, the housing bill that was passed by the Senate and sent to the House, then the House sent back to the Senate. So there is that potential, if that housing bill does get enacted and that provision stays in, that the public welfare investment limit would rise. There's also risk weighting. So there are a number of comment letters going in to OCC and Federal Reserve to recommend a lowering of the risk weighting across the various incentives. I will note that there's an effort to try to lower or expand the amount of credits that can offset your tax liability beyond 75%. That's something that we'll be seeing soon. There's also I think we'll be seeing soon, at least with some of the credits, expanding the carryback to 5 years. And with the exception of renewables, it's generally a 1-year carryback now. And then I would look to individual that actually, let me talk about AMT offset first. There's also potential for tax credits offsetting the alternative minimum tax. And then there's also the potential for Fannie and Freddie, even if they can get to the $2 billion, maybe that goes up again. And then there's been more exotic discussions around opening up individual investors and expanding the allowances for passive activity investments by individual investors, as well as expand transferability of credits beyond renewables. And I think those are a little bit more exotic because those areas need a little bit more analysis before this gets pursued in more detail. And then, Dirk, you can actually correct me if I remember correctly, that LIHTC is a 1-year carryback, or is it?
It is a 1-year carryback, yes.
Yes. So with all of that, who wants to go first? And I discussed a variety of items. Who wants to share what they think is most important, or the top 2 or 3 of those in their particular tax credit area that you're representing here today on the podcast?
Well, since we mentioned the carryback, I can maybe talk first on that a little bit. We talked about a lot of limits, and when banks or corporations are looking at those limits, when it's 75% limit or the 15% PWI, you're doing estimates. You're looking at that saying, what do we think our volume is going to be? What do we think our credits are going to be? What do we think we can use? And then when you go to do your tax return, obviously everything gets trued up and you actually see what you can use, or more importantly, what you could have used had you your exact tax liability. So when looking at that carryback, if you can only carry that back 1 year, being able to carry that back 5 years, you can now look going back 5 years saying, okay, how close were we? Could we have used more credits? And therefore we could use more credits. Maybe we were pushing up against that limit, or that deal didn't close in the fourth quarter that we thought was closed that had all these credits. So there's all these various factors where if you have to constantly be looking at all these limits, you're probably going to build a little bit of a cushion, maybe a little bit of buffer. If you could really know exactly what that is, I think that would really increase demand, because in that first year that you're not going to go from 1 to 5 or 1 to 3, or just, anything greater than 1, I think you would really see it And the investors that are investing in LIHTCs, yeah, we'll start investing in credits now so we can expand that carryback. The one issue might be obviously the LIHTC is not earned when you close on the investment. It's earned after construction completion and lease up and all of that. So it's not like it's an instant credit, but it will help being able to carry that back more than 1 year.
I'll go next just because there's some similarities, obviously, as we talked about. One that, Mike, I don't know if you mentioned just now, but I know you've mentioned it before, but CRA regulations are another aspect for investors in new market tax credits. And there's been several gyrations over the last 5 years or so as different administrations have come in and had different preferences in terms of what those should look like. And that has a real impact on CRA motivated investors. New market tax credits and low-income housing tax credits both qualify to meet those. And so simplifying or at least making them predictable so that investors can look ahead and understand how they're going to plan out their investment strategy, I think is another area in addition to the PWI and the 75% limits that we've already talked about.
All right, well, Tony, it sounded like you wanted to increase the corporate tax rate to 35%. Once you were getting that last question.
I was just saying the consequences of changing the tax rate. I wasn't advocating.
Which obviously had a huge consequence to the low sensitive tax credit, but I don't want to cause any PTSD or anything. I will just note, Brad, I appreciate your comment about CRA and linking that with the PWI, because there is also an effort, a request for comment from the bank regulators as to what should or shouldn't qualify as a public welfare investment. And there is an effort by many banks and bank associations to expand what qualifies as a public welfare investment. And so it'll be interesting to see what happens there and to what extent expanding what qualifies as a public welfare investment, what those investments get made, to what extent those investments will end up generating CRA credit, such that LIHTC and new markets have more to compete against relative to other activities. But Mike or Tony, who wants to go next?
I can go next because I think I answered it in the last question. With historics, I think the two biggest things that can be done are to return the credit to a 1-year credit and to eliminate the basis reduction and make it not be taxable credit. Combined, those would have a pretty significant impact on credit pricing and kind of claw back some of those losses that you mentioned earlier, Mike.
Yeah, I would note that the basis adjustment changes over a 10-year score for both new markets and for historics. They don't have a huge cost relative to the value. So those are definitely two that, as you both know, I've been a big fan of trying to get that enacted.
And Mike, as you mentioned, the basis reduction for historic, I talked last episode about there's a lot of historic LIHTC deals. And when you have a basis reduction, not only for making the historic taxable, you have a basis reduction for LIHTC. There's ways to structure around that, but some LIHTC investors don't like those structures. So yeah, just eliminating that total basis reduction, I think would help out the LIHTC historic combo deals that we see out there.
For sure.
And that was a topic that came up at my Senate committee testimony 2 years ago about ways to make the various credits work better together. And that was certainly one that I identified in the written testimony. Tony, bring us home.
Yeah, Brad talked about this earlier, friction points, and trying to strip out any friction that you can to make it easier for investors to get in the program. There's two things that really come to mind. Number one, the renewable energy industry has real tax law change fatigue. Okay. When the Inflation Reduction Act came out, that was just like an enormous tax law change to renewable energy. It took a long time for folks to understand what the new rule changes are. Implemented a lot of new compliance requirements with prevailing wage and apprenticeship criteria or domestic content criteria. It just made qualifying for credits a lot more complicated, which it already was before the Inflation Reduction Act came out. And then you fast forward 4 years and you get a new administration that comes in and you just get a completely different new set of rules. And I think the industry is they're just exhausted and they're tired. They spend so much time trying to structure and qualify for tax credits to monetize them. It'd be one thing if some big changes were enacted, but you felt like, okay, that's settled and all we have to do is learn this set of changes and we feel comfortable that we don't have to brace ourselves for a massive set of tax law changes in just a few more years from now. But right now, the way the industry is looking at it, they're just looking at every 4 years. If you get a change in the White House and a significant change in Congress, you're going to see a massive tax reconciliation bill, totally rewrite the rules again. It's becoming like a full-time job for people who aren't tax accountants and tax attorneys to understand how to get their deals financed. So I think there's some real fatigue there. I wish we could just get more stability and less of this seesaw approach to tax policy. The other thing is,
follow up on that a second, because I couldn't agree with you more. And one of the criticisms of the various tax incentives is the complexity.
right,
And I always think that buying a home's complex and the rest, but pretty much the documents have all been set in stone. There's a lot of stuff that has to happen, but it's been done over and over and over again. You get these efficiencies. And just
Right.
as I feel like, just as we're getting the flywheel turning faster and faster and faster, getting more and more efficient, then all of a sudden there's these changes.
yeah, I
So
know.
it's like, just don't change things for a while. We can get more efficient.
Exactly. You have a tax reconciliation bill that gets passed. You need additional guidance to clarify aspects of that. You need treasury regulations. It takes time for those rules to come out. And then once they come out, it takes more time to understand
Right.
them. So there's just a real drag on efficiency there for sure. Less of a seesaw sort of approach to tax policy would be great because it just keeps investors on the sidelines. Another thing that could be great, and we've talked about this before, is if the FASB could, for LIHTC, you're supposed to use PAM. If you're an investor and you make an equity method investment into a partnership that qualifies for low-income housing credits, you use PAM. That's it. It's that simple. In renewable energy and in new markets and historics, you have to evaluate a set of criteria to figure out if you qualify for PAM. It would be nice, and for these other credit programs, if PAM was just, that's what you do. If you're an investor and you make an equity method investment, you use PAM, proportional amortization method of accounting. The accounting treatment does keep a lot of it, which is kind of sad. There are a lot of investors that like everything about the renewable energy project, the benefits, the returns, et cetera. They want to make the investment. They choose not to invest because of the GAAP accounting treatment. And that's terrible.
Agreed. That gap accounting method should not be adversely influencing choosing to invest.
Right. And at the end of the day, I think most people who understand this program well enough truly feel as though that the PAM results, if anything, provide users with better information so that they can make informed business decisions. I don't think they feel as though ABV actually provides them with better, useful information so that they can make a more informed business decision. It's unfortunate. So I'd say the tax law change and GAAP accounting policy are probably the biggest friction points for renewable energy investors.
So who would have thought that a podcast talking about these incentives with 5 accountants would end with a gap accounting issue? I think it could have been predicted. We could keep talking about this for a while, but I know we need to get back to our practice. So thank you all for joining me on the podcast. To our audience, I do encourage you to reach out to my guests via the show notes for this episode to learn more. There were a number of resources that were recommended on the last podcast, so I won't ask my guests to restate all of those. Please do go back and listen to part 1 of the podcast. I do think listening to part 2 followed by part 1 is just as good a way of listening to 2 podcasts. And let me also say, if you got value out of today's episode, this is to the audience. There are 4 ways that we've identified for you to support Tax Credit Tuesday and help more industry colleagues discover the insights we share here every week. And if there are other ways, please send them to me at contact@novoco.com. But number 1, please subscribe to Tax Credit Tuesday. Second, please visit the show notes to connect with my guests and explore the additional resources. 3, please share the episode with colleagues and others in your network. And 4, if you have questions or ideas for future episodes, please send an email to contact@novoco.com or just post them online in the comment section. Please do let me know if you want a deeper dive podcast going into all the various areas that I went over pretty quickly on factors that influence tax-free equity pricing. One more time, let me thank you all for being on this episode and the previous episode of the podcast. And with that, let me turn to my guests, turn to the audience and say, thank you for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.